give you some technical information on the webinar. Due to popular request, we will today use Teams for this webinar for the first time, and please note the following points. All participants are muted and cameras are off. For best viewing experience, we suggest that you use the speaker mode. You can ask your questions in the Q&A section, and you can like questions of other participants that you wish to be answered. So we have a prioritization of questions. And I can tell you that both the presentation and the recording of the webinar will be available after the event. So much about technical details. I'd like to briefly mention the sponsors of this market study that we are going to present to you now. We are very happy to have counted on the support of the following main sponsors: Allianz Global Investors, Blue Orchard, PineBridge Investments, Raiffeisen, UBP, and Zürcher Kantonalbank. And we also had support from the following valued supporting sponsors: Coninco, Energy Infrastructure Partners, J. Safra Sarasin, Pictet, Responsability, and Robeco. By the way, you will find interesting sponsor contributions from all of them in the report and on the specific microsite. Now, what about the agenda of today? After the brief introduction, I will be happy to hand over to Patrick Odier, President of Swiss Sustainable Finance, for a short welcome note. And we will then come to the core part of the webinar, which is the presentation of the market study results. We will have a section on regulatory updates with Katja Brunner, our head legal and regulatory. And we will then have hopefully ample time to answer a lot of the questions that may come up during the webinar. So with that short technical introduction, I am happy to hand over to Patrick Odier for his welcome note. Thank you.
Thank you, Sabine, and welcome in turn to all of you who have been joining us for that webinar. We're very happy to have the entire SSF team with us this afternoon. We'll be able to go into questions and answers with all the competence needed. But we're also very, very happy to have with us Professor Timo Busch, who's been accompanying us since 2018, i.e. since the beginning of the publication of this market study. Thank you very much, Professor. We look forward also to your participation to this afternoon's discussion. A few words of introduction on my side, just to relate, of course, this study to the current environment. Sustainability-related investments have faced, as you know, a challenging environment over the past year, as have actually all asset classes or all styles of investments. Negative market performances, that is minus 18% of 2022, has hit sustainable investors as well as their mainstream peers. And in addition to that, many banks and asset managers chose also to take a perhaps more conservative approach in reporting their sustainable offerings. Their aim is, not, of course, to address the so-called greenwashing risk, which are, of course, very pertinent and also a high priority for the market player. Rising regulatory complexity is another reason that we can attribute the absence of common agreed definition to the fact that uncertainty being created, volumes are also a bit more hesitant to increase or to grow as fast as they have in the past. As a result of these and other factors, the volume have indeed declined in 2022. But does that mean that sustainable investments are in crisis? Clearly, absolutely not. We see these developments as a natural step in a phase of complete mainstreaming of sustainability-related investments. And let me perhaps go over one or 2 points to substantiate this approach. First of all, it's not really surprising to see a slowdown after such a considerable number of years of considerable growth. Market shares of sustainability-related investments are, at least for some of its segments, higher than 50%. And when markets have high volumes, growth rates are naturally being a bit reduced. In addition, considering that sustainability-related investments are now offered for most asset classes and reflect standard asset allocation, it is normal that volumes fell in line with the strong bear markets of 2022. For the asset classes covered in the report, total market performance was, as I said, minus 18%. It is not really reasonable to expect that sustainability-related investments could escape such a trend. Now, a word about greenwashing. Current efforts to combat greenwashing illustrate that sustainable investments are taken more seriously by market actors. But clients have also growing expectation with regard to the impact of such products. That is a positive development, as we have to use the lever of investments as much as possible. That comes with the responsibility of product providers, of course, and that comes also with the responsibility to use careful communication regarding the objective of sustainability-related investments. This will foster understanding and contribute to bolstering trust in such investments. And the federal initiatives, such as the Swiss Climate Score, as well as initiatives for more transparency by different associations, will play a significant role, I believe, in facilitating clear communication. Two words on the financial regulation, perhaps. Sustainable finance regulation may be perceived as a burden by market actors. So far, it seems that it hasn't brought about the intended clarity vis-à-vis the clients, but it led to higher sensitivity with regard to the establishment of sound investment processes and clear communication on them, and that is very positive. Ongoing discussion regarding definitions, regarding labeling and reporting requirements would lead to even better frameworks contributing to improved transparency. Ladies and gentlemen, in conclusion, in light of this development, we've chosen to focus this year's Swiss Sustainable Investment Market Study on bringing different perspectives into the discussion. Kelly Hess will tell you more about it just afterwards. We think indeed it is vital to lead an informal dialogue between all stakeholders to define a principle-based framework that allows clear classifications of different types of sustainable investments. More transparency on objectives and clear information on results are needed and to be fostered. Such information will provide investors with a foundation for choosing products and services that match their goals, be it alignment to specific values, improving the risk-return profile, or probably most importantly, to make a clear contribution to the much-needed transition to a sustainable economy. I now hand to Kelly, who will guide you through the results of this year's market study, and we'll come back at the end of the presentation for the question and answers. Kelly, the floor is yours.
Thank you very much, Patrick. I'm now very happy to present, together with Timo Busch, the results of this year's market study. So this year we decided to do things a bit differently and shift our focus. The market has evolved so much since we first started reporting on sustainable investments. We know through discussions on the federal level, to discussions with market players, both in Switzerland and internationally, that we simply are not speaking the same language when it comes to sustainable investments. Some prefer a rather narrow view, while others a broad view, and quite a few fall somewhere in between. But what is clear is that there is no current official consensus of what counts as a sustainable investment. There's no one qualifying factor yet, which is also a reason for the current criticisms and greenwashing claims. Therefore, this year we adopted the terminology sustainability-related investments. We refined our methodology to include more qualitative aspects, and we offer not just one, but numerous perspectives on the reported volumes. And in so doing, we hope with this to contribute to the ongoing discussions on defining sustainable investments, while pointing out the complexities such an endeavor faces. So as in previous years, we collected self-reported data on volumes applying one or more of the commonly accepted sustainable investment approaches. And these range from exclusions to ESG integration, all the way through to impact investing and stewardship approaches. And these approaches have been accepted by the market and have been till now the more or less undisputed standard for indicating if investment products integrate sustainability aspects. You see these approaches listed here and matched with specific investor goals. each approach is more or less suited to fulfill certain goals, such as aiming for better financial performance or aligning with certain values or creating positive change. And this year, based on the AMA's self-regulation published in 2022, we also added to the analysis the approach called climate alignment. And this refers to assets which have certain greenhouse gas emission targets in line with global climate goals. In addition to collecting rather quantitative data on the approach level, this year we added some quality questions on mechanisms of impact and measurements based on the Eurosif white paper methodology, but that Timo will go into in more detail later. So every year we send our questionnaire out to the Swiss market, and this year we had very stable market participation with a total of 91 participants managing assets in Switzerland, and a very good mix of asset owners to asset managers and banks. And I have to say a very big thank you goes to all of these participants. We very much value your efforts in answering our detailed questionnaire. And we know it can be burdensome at times, but without your participation, we would not be able to follow and report on what the Swiss market is doing in respect to sustainable investments. And in addition, some of these participants are also part of our group of experts who help us adapt and update the questionnaire each year. So a very warm thank you to those participants if you're listening also. So without further ado, based on the data we collected this year, after years of double-digit growth, the market volume of sustainability-related investments in 2022 did decline for the first time by 19% to 1.6 trillion Swiss francs. This was, however, very much in line with market performance of 2022, which was around 18%, taking into consideration the major asset classes. So I have to apologize for reminding everybody about the markets in 2022, but even sustainability-related investments could not escape the bear markets. At the same time, we also know from market players that some became stricter about what they reported as sustainability-related assets. Therefore, we would have actually expected steeper declines than what we see here. So the fact that the full volumes only decreased by approximately the same percentage as the negative market performance indicates that there were most likely no substantial outflows, and that instead inflows could have compensated for some of the negative market performance and stricter reporting. Also, on the level of funds, we know that approximately 50% of overall Swiss fund volumes are represented by sustainability-related assets, just as in previous years, and therefore the market saturation of sustainability-related assets seems to be rather constant. So now let's look at a brand new aspect of the report that we implemented this year in response to the growing debate on defining sustainable investments. The bulk of this year's report is dedicated to providing different perspectives on looking at sustainability-related investments and contributing to the discussions. So here you see an overview of the 3 perspectives we looked at this year. Well, 4 if you take into consideration the unsegmented perspective. And we'll go into each of these in more detail right now. And just to give you an overview, we first looked at something that we've actually done in the past, at how many approaches that the volumes apply to their sustainability-related assets. Second, we looked at the AMA's self-regulation, and we put that into practice and applied it to the volumes we collected. And third, in the green bar, we applied the Eurosif methodology, or a classification that was published in a Eurosif white paper authored by Timo Busch, and we looked at that as our third and final lens. So looking at these each in a little bit more detail, now let's look at the first lens, which was looking at how many approaches were applied. We saw that overall, 83% of the total sustainability-related volumes apply combinations of at least 2 or more approaches. On the level of 5 or more approaches, for example, this jumped from 27% last year to 35% this year. And as I mentioned earlier, we know each SI approach is more or less suited to meet the various investor goals. So a combination of approaches likely contributes to multiple goals. So we conclude that as approximately 2/3 of all volumes apply 3 or more approaches, that the majority of sustainability-related investment practices have the objective of looking at sustainability from different angles and also considering various investor motivations. We would also like to emphasize, though, that the sophistication of a sustainability-related investment cannot simply be derived from the number of approaches applied, but combining more approaches can definitely be an indication of higher efforts and ambitions. So secondly, we looked at the AMA's self-regulation published in 2022. The self-regulation does not fall under FINMA supervision. However, AMA's members are required to comply with the guidance, and it obliges asset managers offering products positioned as sustainable to ensure the necessary infrastructure and qualified resources are in place, and also that governance, investment management processes, as well as sustainability metrics are documented. The self-regulation also specifies that collective investment schemes and assets that only employ exclusion or ESG integration approaches do not qualify as sustainability-related collective assets. So by deducting those volumes that apply only exclusions or ESG integration from the total Swiss sustainability-related volumes, the resulting volume is 1.38 trillion, or approximately 85%. And compared to the 1.6 trillion total sustainability-related volumes. And the choice to exclude these two single approaches, exclusions and integration, from the definition of sustainable investing, while declaring that all other approaches applied alone do deserve the term sustainable, that reflects a growing ambition for sustainable investments, namely that they should serve goals beyond values alignment or risk reduction. So if you remember from the chart I showed earlier, these two approaches had very little ambition to produce a positive change. And there are still a lot of open discussions about if this methodology is fit for purpose and aligned with future expectations. But it is one of the few methodologies we have readily available to help start classifying existing sustainability-related assets. So now to present the results of our pilot study based on the EuroSIF white paper, which incorporates a bit more of an in-depth analysis and qualitative aspects, I hand over to Timo Busch, who authored the paper and is our academic partner for this report.
Many thanks, Kelly. Warm welcome from my side. It's a great pleasure to be here today. I have to say again, for the 6th time as academic partner working on the SFF report. And this time I'm especially happy to be here because we did something totally new compared to the last versions. And the motivation for that was that I see two big questions that we need to answer. The first one is, how do we want to define sustainable investments? We don't want to give an answer to this question today, but the second question is, what is actually the contribution of the different SI volumes to the transition of the economy? And this is a question we try to answer with this year's market report. Now, next slide, Kelly, please. What you can see here is basically the underlying methodology. And without spending too much time on it, let me say, if you're really interested in the details of how we try to cluster the volumes, this is the EuroSIF white paper. Go to the EuroSIF webpage, and there you can find the white paper and read all the details. So let me just briefly introduce these 5 categories. And if we start on the left-hand side, you see exclusion focus. So I would argue this is an investment type where you have the least ambition level towards transition of the economy. by purely excluding companies and sectors, you as asset owner, basically, you won't change anything at all. And if we move on to the right-hand side, you would see the dark blue category here. We also could say that's the dark green category. This is impact generation. So these would be investments where you as investor, you could claim whatever change took place in the real economy, this change occurred because of your investment. So you had an active investment contribution. So, and the three remaining parts are kind of in between those two extremes, whereas the ambition level increases from one category to the other. We labeled this here with double materiality. So basically indicating that on the really right-hand side, you would have a high level of impact materiality as well as financial materiality. Now let's have a closer look at the three categories in the middle. Next to impact generating, we have this investment type impact aligned. It's closely related to impact generating, but the major difference is that you basically invest in companies that already have a positive impact. So as an investor, you cannot make the claim this positive impact can be related back to your activities. Then the next category would be advanced ESG investments. And we would argue here you have a systematic and a sophisticated analysis of ESG factors, and you incorporate that in the investment appraisals. However, it's one step below impact aligned. So, and that's basically because you're not able to indicate the company impact that you achieve with those investments. The next category is basic ESG, and basic ESG is basically like a big bucket where we have everything in there what doesn't fit to the minimum criteria of advanced and the impact categories, but goes one step further than pure exclusion-focused approaches. So these are the 5 categories for which I believe we nicely can illustrate different ambition levels towards the transition of the economy. And let me at this point mention one important thing, and I will come back to that in a second. One major distinction between basic ESG and advanced ESG is next to the fact that you need to have some sort of a more sophisticated approach how you analyze and integrate ESG factors. One major difference is that you have some sort of an ESG performance measurement. So a requirement here is, in order to be more transparent about what you do as an investor, to deliver the information what the ESG performance of the portfolio is. You could do that, for instance, by using ESG ratings. Let's go to the next slide, please, Kelly. Yeah, so here is the main result. On the left-hand side, again, these are the overall volumes of sustainability-related investments. And on the right-hand side, you see now the breakdown based on those 5 approaches that I just discussed on the other slide. And I think what's quite interesting, if we start really at the bottom here, is that around 8% it's impact generating. So where you really can claim as an investor, you contributed to this change. Taken together with the next category, impact aligned, we end up around 20% of the overall market volume that we can relate to impact. The next interesting observation is that basic ESG obviously is the biggest chunk of this overall picture, with more than 50% of all the volumes. And of course, this is kind of an interesting outcome, raises the question why, for instance, is basic ESG such a big proportion and advanced ESG with around 15% rather small. Let me explain that on the next slide. Here we had a deeper look at this 50% bucket of basic ESG, and we looked a little bit deeper into the data that was delivered. And by having this closer look, we actually figured out that, roughly speaking, 60% of these 50% bucket of basic ESG, around 60% actually could be classified as advanced ESG, purely from looking at how ESG factors are taken into consideration. And the reason why we didn't classify as advanced ESG is can purely ascribe to the fact that there was no ESG performance documentation. You may ask yourself why. I have two explanations. Either the ESG performance is actually not measured. Second explanation would be it is measured internally for internal purposes, but it's not being reported or it's not documented so that externally retail investors or institutional investors can have access to this information. So here I see the main outcome of this year's pilot study applying this new methodology. One key message, one key outcome. For future reports, transparency is obviously one main issue we all should work on. Let me conclude this first part of our talk here today. First of all, we see a growing demand for impact-related investments. That's what we know from investor surveys, but this is also something we can observe with the data. Kelly will illustrate in a second that two approaches which are closely related to impact are the only ones that grew last year. More from a conceptual point of view, the notion of company impact and investor impact is really important when we want to be more transparent and more clear about impact investments. Because what I observe is that oftentimes those two terms or the use of those two terms and the meaning are kind of mixed up. So company impact, purely company impact, this is what I would categorize as impact aligned. Investor impact, that's one step further where you as an investor, you can claim you caused this change in the real economy. The results of our Polish study shows that if we say, okay, if we take the more ambitious categories of the user classification scheme, which would be advanced ESG, impact aligned, and impact generating, we have to say roughly 1/3 of the Swiss market follows into this more ambitious fields of sustainable related investments. Yeah, last point here is what I mentioned before, transparency about impact or ESG performance measurement. It's important. I think there is a need for further improvements. And with that, I would stop and look forward to your questions after the next slides.
Thank you very much, Timo, for those inputs and for all your work over the last few months to help us with this report. So I guess you can put in your questions in the Q&A function, and they will be fielded towards the end of the presentation. But first, I did want to give you a bit of a look into some more of the data from this year's report on the level of SI approaches. As Timo alluded to, despite the poor market performance over the last year, 2 SI approaches did report much higher volumes. In 2022, you see them towards the bottom of the chart. Sustainable thematic investments increased by 86% and impact investing by 80%. And we see this as a reflection of the growing investor appetite for impact-related approaches. And as I mentioned before, for the first time this year, we did collect data on the climate alignment approach. You see that also in this chart, which focuses on reducing the carbon footprint of a portfolio according to the target set of the Paris Agreement. And with 375 billion Swiss francs already reported for this approach, which is around 23% of the total sustainability-related assets, this approach is already well established in the Swiss market. Then on the approach level, One thing that I also wanted to highlight is an analysis we did this year on engagement and voting. So with regard to stewardship approaches, you see here the percent of total volumes reported as using engagement or voting, which are outsourced to external providers by both asset managers and asset owners. So you see that there's a high level of outsourcing on both the engagement and voting side, while particularly for asset owners, they tend to outsource the responsibility. So that means that the success of stewardship goals crucially depends on how strictly service providers interpret policies and how well their discussions are and decisions are aligned with the goals of the owners of the wealth. And it's clear from these high values that in the future, we may need to adapt our study to also collect data on how this process is tracked and amended based on the results achieved through these stewardship activities. So also, I wanted to take a closer look at the newly introduced approach, climate alignment. Throughout the past few years, Swiss players, especially those having net zero emissions ambitions, have launched strategies aiming to decrease carbon footprints and intensities for certain portfolios. Based on the respondents, this approach is already being applied to about a quarter of all sustainability-related investments in Switzerland. As we introduced this approach for the first time this year, we also tried to ask some basic questions around the approach. One being, what target scenarios does your portfolio attempt to align to? So not surprisingly, we saw that the majority answered 1.5 degrees, and about 25% answered that they wish to align to a 2-degree scenario. There were actually 12% of participants who chose neither of these common scenarios, and their answers actually point out certain complexities with this approach. So when we took a closer look at other, we observed that targets often were not linked to a specific temperature scenario, but rather to the reduction of absolute emissions or of exposure to high emitters while increasing exposure to low emitters. And some of the assets stem also from the private markets, for which data availability is often very limited. So therefore, some private equity firms attempt to remedy this by using engagement to establish processes for greenhouse gas accounting within investee companies. And they consider this to be a contribution to the transition and hence a climate-aligned portfolio. And when speaking about climate-aligned portfolios, in Switzerland, we also have to mention the Swiss climate scores. So the Swiss climate scores were published by the Swiss federal government in 2022, and they aim to establish a baseline for best practice transparency on the Paris alignment of financial investments. And they are voluntary. Implementation of the scores is still in its infancy. And from our study, we did ask a question or two on this. And from our study, we saw that already about 1/3 of asset managers surveyed say they plan to publish Swiss climate scores in the near future. So therefore, soon we may be able to find more quantitative and standardized information for this approach. So those were just two highlights that you can find also in the study, and you can find highlights on each of the approaches also within the full study. We also took a look at some special topics within the report that are gaining a lot of attention. So for instance, I want to highlight real estate. The real estate sector's contribution to the transition to a more sustainable economy is becoming more significant, especially as investors can link direct environmental and social benefits to the proper management of real estate portfolios. So it's also of particular importance in Switzerland, as asset owners commonly manage direct real estate investments with internal resources, while they externalize a lot of the other asset classes, the management of a lot of other asset classes. So therefore, these asset owners can really act as a lever for change when it comes to real estate. And we saw some very positive results so far. Of the 50 respondents who replied to this question, 71% of them consider sustainability certificates of objects when developing or selecting real estate investments. 42% of respondents indicated benchmarking their portfolios through established benchmarks such as GRESB. And in addition, very positive result was that 80% of respondents have carbon footprint or intensity reduction as a declared investment strategy or goal. And also another positive result in Switzerland, I mentioned AMAS again, they have a self-regulation published. They published a set of environmental indicators for real estate funds in 2022, and they are mandatory for AMAS members and represent an important first step towards defining industry-wide real estate compatible environmental indicators. So of the 35 respondents to this question, the vast majority do collect data on the 5 main indicators, while only a minority have already published this data. So we anticipate this trend to increase as the indicators become more established in the market. And we see these as very positive signals within real estate investing, and we're interested to see how sustainable real estate investments develop, especially with the passing last weekend of the Climate Innovation Act, which is bound to unlock some more capital for improvements in the field. So turning now to the debt investments, on a global level, sustainability-related debt investments such as green and social bonds have grown significantly in recent years, peaking at around $1.1 trillion in 2021. And the topic of debt has also been growing on SSF's radar. We recently initiated a member platform, which will be looking more closely at the topic of financing instruments aiding the transition. So in our study, when asked whether asset managers or asset owners invest in sustainability-related debt instruments, 61% replied that they did invest in such instruments. Green bonds were listed as the most common investment by volume, followed by social bonds, and then sustainability bonds and sustainability-linked bonds. But with the total only around 46 billion Swiss francs invested in such assets, this is still a bit of a niche market for Swiss investors. And respondents were also asked whether their debt investments were subject to any external reviews. And based on the data provided by participants, only a very small fraction of the reported sustainability-related debt investments has been certified, for instance, certified by the Climate Bond Initiative, or has third-party assurance or second-party opinions, or has a green, social, or sustainable bond rating. So with anticipated increased focus on financing instruments that will help us achieve the transition, it will be interesting to follow developments in the debt markets, especially our local markets, to assess how debt instruments are helping move the needle towards a sustainable future. So those were just a few highlights from the report. If you have questions, like I said, please ask them in the Q&A. And now I would like to hand over to my colleague Katja Brunner to give a brief summary of regulatory developments.
Thank you very much, Kelly. A warm welcome also from my side. In the next minutes, I will give you a very rough overview on the most important regulatory developments in Switzerland and in the EU. I will focus more on Switzerland, but of course you can find much more information in the regulatory chapter of the market study. Let's start with Switzerland. Parliament was very active last year and amended the Swiss Code of Obligations. The new provisions provide for 2 important obligations: reporting obligations on non-financial matters and due diligence and reporting obligations in relation to mineral, metals and child labor. For time reasons, I will focus on the transparency on non-financial matters. The Federal Council specified the requirements for climate disclosure in an ordinance. That means that large companies that base their report on the TCFD recommendations will be assumed to be compliant with the climate reporting obligations in accordance with the CO. The ordinance will enter into force in January next year. Next slide, please. Of the 52 banks and asset managers taking part in the survey, approximately half are subject to this legal climate disclosure obligation and have to comply by following the TCFD recommendations. This figure shows which of the 11 recommendations of the 4 thematic areas mentioned by the ordinance are currently in use and to what degree. At this stage, the Swiss market seems to be implementing the TCFD recommendations to a certain extent, but many organizations that indicated that they do not yet implement particular recommendations also stated that they plan to do so by the end of 2023. And at this point, we would like to inform you that we plan to publish a guidance on how to implement the TCFD recommendation this summer. We don't know about the exact date yet, but we will let you know soon. The Federal Council. What were the key measures of the Federal Council? In summary, the Federal Council reconfirmed that it wants to further strengthen and promote Switzerland as a leader for sustainable financial services. In September, the Federal Council adopted the message on the revised CO2 Act, and as a measure in the financial sector, FINMA and the SNB shall report regularly and publicly on climate-related risks. And this means that FINMA has the obligation to regularly review climate-related financial risks of supervised companies and to publish a report on the results. The revised CO2 Act still has to be adopted by Parliament. In June, and as Kelly already mentioned, the Federal Council launched the Swiss Climate Scores. And at the end of the last year, the Federal Council published a new report on sustainable finance in Switzerland. The government plans 15 measures for 2022 to 2025 to consolidate the Swiss financial center's position as a leading global location for sustainable finance. Last but not least, in its position on the prevention of greenwashing in the financial sector of last December, the Federal Council emphasized the need for a uniform understanding of the conditions required for products and financial services to be considered sustainable. The Federal Department of Finance will present its proposal on the next steps to the Federal Council in autumn this year. FINMA analyzed the first disclosures on climate-related financial risks. We can see this on the next slide. So banks and insurance companies of supervisory categories 1 and 2 were required to include in their annual reporting for the financial year 2021 in accordance with FINMA circulars, disclosure banks and disclosure insurers. In November last year, FINMA published a new guidance and set out the key findings from these disclosures. While FINMA recognized that transparency has improved, but it also points out that in general, the information disclosed does not give a clear picture of how relevant climate-related financial risks are for the individual institutions. As a result, the supervisory authority communicated the areas for improvement. In its guidance on developments in the management of climate risk of January of this year, FINMA refers to relevant international developments in the area of climate-related risk management, and FINMA expects the supervised financial institutions to engage proactively with the recommendations and guidance provided by international bodies such as PCBS and IAIS. Well, based on the revision of the CO2 Act and the international developments I mentioned before, FINMA announced that it will elaborate a new circular on environmental risk management, including the risk of biodiversity loss. FINMA is expected to conduct a public consultation on a draft proposal by the end of this year. Next slide, please. In the course of the last year, several finance associations published a self-regulation guidance and recommendations, as we already heard. For more detailed information, please have a look at the regulatory chapter of the market study. Now, let's have a look at the key regulatory developments in the EU, and I will start with the SFDR. Since January of this year, the RTS are applicable. They contain detailed implementation rules for the pre-contractual and periodic disclosures of Article 8 and 9 products. To acknowledge some of the concrete implementation issues of SFDR, the EU Commission mandated the ESAs to review and propose amendments to the RTS. The ESAs published a joint consultation on the review of SFDR delegated regulation in April this year. Also in April, the Commission answered some key questions regarding the SFDR. It confirmed that the SFDR is not a classification system, but a disclosure framework. There are no minimum criteria to qualify the concept of sustainable investment. The SFRD does not prescribe any approach to determine the contribution of the investment to an E or S objective. And this means that each financial market participant must determine and disclose to investors its own methodology for his assessment. With regard to the taxonomy, there was quite some development in the last year. As you know, there are several delegated acts to supplement the taxonomy regulation. Applicable since January 2022 is the Climate Delegated Act. It defines a list of technical screening criteria of the first two environmental objectives. Also applicable since January 2002, Article 8 Disclosure Delegated Act. And since January this year, the complementary Climate Delegated Act, which includes nuclear energy and natural gas as transitional activities, has been applicable. Finally, in April this year, the Commission launched a consultation on its draft of the long-awaited Delegated Act for the 4 remaining taxonomy objectives. The expected application date of this Delegated Act is January 2024. Since January 2023, the CSRD has been applicable, and it is important to note that the CSRD applies to all companies or groups based in the EU, regardless of the origin or domicile of the parent company. The timeline of application for the reporting obligation depends on the company's size, as well as its net turnover and total assets. By the financial year 2028 at the latest, companies based in the EU will have to report even on the activities of the non-EU parent, for example, a Swiss parent company, if certain complementary conditions are fulfilled. So the survey shows that only a minority of banks and asset managers see themselves as subject to the reporting requirements. Yet the fact that 25 companies did not answer the question may indicate that the market is still analyzing the extraterritorial effects of the CSRD. Last but not least, according to the survey, there are 4 factors hindering the implementation of the EU regulation. First, the lack of clarity within a specific regulation. Second, a lack of definition of sustainability terms, but also tight timeline for implementation and a lack of alignment between the different regulations make it difficult to implement the EU regulation. Thank you very much for your attention. I hand back over to you, Sabine.
Thank you, Katja, for your contribution, and thanks to all the others for giving this concise overview on the results of our market study this year. And we now have the opportunity to dive a bit deeper based on questions that you bring to our attention. I already have 3 in the Q&A, and we will address them immediately, but I encourage all other participants to add their questions too, and all the speakers are prepared to answer them. So I start maybe with the question from Rico Keller. He referred to the overarching chart showing the 3 different lenses and really asked the question of why we didn't add the view of what share of volumes are under Article 6, 8, or 9 classification. Kelly, would you like to briefly answer it?
Yes, I can answer. So we do have data on the share of volumes that are classified as such, but we didn't put this into the main chart because these articles were not really meant as a classification system. They're just a kind of a transparency guidelines. And what we saw this year is that from participants, there might have been a little bit of confusion because we received basically only 50% of the volumes were linked to Article 689, or for instance, participants also answered it was a Swiss fund only. So for about half the volumes where they could have answered, we didn't get an answer. It was not disclosed. And for about 20%, the answer was this is a Swiss fund only. So it really putting a classification of 6, 8, or 9 doesn't make any sense. And then for the rest, you can see it on page 35 in the report. We had 8% Article 6, 15% were Article 8, and another 8% Article 9. So relatively small amounts of the total volume were reported this year.
And maybe we can say on top that, of course, such a classification would only have been applied to funds. And in our statistics, we also show mandates plus assets managed by asset owners. So by nature, it would have related only to a minor share of the total bar. Thank you for this, Kelly. We then have a question from Tadas Sukas. He actually refers to something you briefly outlined at the beginning of your presentation, Kelly. He asks, why did you use this new term of sustainability-related investments? You outlined on it a bit, but maybe you can just briefly repeat the main reasoning behind this, as it is a key change of this year's market study.
Yes, sure. So when we were going into this year's market study and discussing the methodology and the main messages, we do work with a group of experts from the industry. We also talk to people on the federal level, on an international level, at Eurosif, for instance. And what we kept hearing was different definitions of sustainable investments. So, I mean, the definition we've been using for the past years, for that time, was, in our opinion, the right definition. But things have changed a lot. There's a lot of flux in the market now. As an example, when we have our meetings with experts from different institutions, we already noticed there that they were claiming that they have different views on what to call a sustainable investment or not. So at the moment, there just really isn't a consensus. And we would have thought that and now we finally think it's the right time to change. We've actually been discussing that for a few years, how we saw this trend coming, that there is no, one official qualifying factor to label something a sustainable investment. And that's been kind of, the discussions have been increasing over the years. And so that's why this year we decided to change to sustainability related investments, because we don't feel like we can report this one volume. We just don't have the data behind it to report one volume of sustainable investments anymore, due to the huge market changes and discussions going on.
Thank you, Kelly. I hope this answers the question. And we then have another one from Sasha. How is ESG voting defined? Is that more for maybe you, Kelly, as well, and maybe Timo wants to complement?
Yeah, I mean, well, we do give some guidelines to the participants. We also have a chart within the report, and basically ESG. We do definitely state that it has to be, you know, ESG voting. So there has to be some kind of link to sustainability factors, and what we write in the report is that it has to be basically an act. They have to be actively exercising their voting rights based on ESG principles or an ESG policy.
Any other comments, Timo?
Yeah, maybe just briefly that, of course, voting can be a key mechanism for impact investments. So that's where you, as an investor, actually, you have the chance to influence companies through voting behavior as well. For instance, similarly to dialogues or other stewardship strategies. And therefore, it's an important strategy. And if it's well documented, the success of such strategy, that would be then sufficient to qualify as an impact generating investment.
Thank you. Now we have a new question from Dominic Foster. He says, in view of discussions on greenwashing, what ESG approaches shall be implemented in financial products in order to qualify as sustainable? So exactly the question we really also debated ahead of preparing the market study. And you ask, what is SSF's position in this discussion? I would maybe start and then I hand over to Timo as well. I think it's important to see that it's difficult to just link this question to ESG approaches. We feel more than defining specific approaches as qualifying as a sustainable investment or not. It is important to have more transparency on what you actually intend to achieve, and then also report on results, more so than just linking it to single sustainable investment approaches. One fact that definitely supports this view is that the majority of the investments we see in this study already use more than one approach. I think it's more than 90% that use that, or Kelly, you give me the exact figure, that use more than one approach, so they already serve different goals. But that's one view on this question, and maybe Timo, you comment on it more from the academic perspective.
I mean, the main purpose of this pilot study on the new classification is exactly to give some guidance how you as an investor or an asset manager can move forward and have more ambitious products. So, and then I think it's becoming quite clear that purely doing exclusions, that's probably not enough. But then also say we have to realize that impact generating maybe is not always feasible with equity investment. So there might be some limitations. But in between, we clearly lay out how to be more impactful. And I just give you one example. We also asked the question, when a best-in-class approach is applied, what is the effect of the investment universe? And if you have a look at the market report, you will see the numbers, and you will realize that some market players have a rather rigorous approach where you have a investment universe that shrinks by around 50%, while for others, 90% remains investable. So, and based on this kind of information, this can give you an indication whether you have a more impactful ESG strategy or not.
Thank you, Timo. And we have an interesting question from Sasha Görlitz, our colleague from F&G. Thanks for being with us today. You ask, where have been the main challenges to receive, analyze, and evaluate data based on the new methods? What were the specific limits or constraints of this new method? And I think we definitely can talk a bit about this. Maybe, Kelly, you want to go first, and then Timo can add on it.
Sure. So yeah, basically in first discussions with Timo and his colleague Eric, who were helping us implement some new questions this year, we noticed there was definitely a lot to be translated from that EuroSIF report. So we tried to ask, you know, fitting questions that would give us the quality information that we needed to segment the volumes, and it wasn't always easy. Sometimes we wanted to specifically ask, you know, do you see as yourself as having an investor impact, or is this a company impact? And these terms that are kind of well used within the academic community are maybe not so well used by practitioners. And I think that was one of the first steps to kind of translate the academic speech into what practitioners could answer. And we're definitely going to go back and look at these questions that we added to the questionnaire and see if we can improve them for next year.
Yeah, maybe two things from my side. The one insight that we gained is that, of course, we had to translate some questions, some aspects, but in a nutshell, it was not that we had 100 new questions that we needed to add to the questionnaire. So it was doable. So that was the one insight. And the other insight is that, yeah, I mean, it was a pilot study. We had our learnings, and maybe some questions were not as precise as they could have been. And this specifically holds to questions about ESG measurement, ESG strategies, how to make them transparent, so on and so forth. So, I mean, here are learnings, and we definitely incorporate these learnings also in the further development of the project with EuroSIF, where we would like to propose by the end of the year a standardized version questionnaire, how to do such market studies in future.
Thank you, Timo and Kelly. Right now, I do not see any additional questions in the Q&A section. Take your chance and bring up the points that are urgent for you, or the questions that you would want us to clarify. If there is no further question from the audience, you know that you can always also reach out to us after the webinar and bring up any additional questions that you may want us to reply to. But with that, we would then close this Q&A session. And before fully closing the webinar, let me just once more refer to our sponsors. We thank all our sponsors for supporting us in preparing this important piece of orientation on the Swiss sustainability-related investment market. And under this QR code, you find the microsite that provides the summary of the report and also the link to the full report. So check out the full PDF, something like 88 pages, so definitely a bit of a read to go through it, but we hope that you can pick some bits and pieces that are important in your daily work. So unless there is a last question, we would herewith wrap up, and we thank you all for having been with us.